The following is a presentation of TFNN. Live at TFNN, the Power Trading Hour, with your host, David White. Now, the author of The Path of Least Resistance and The Tech Insider, David White.
And good afternoon. It's a beautiful July 2nd down here in the headquarters of technical trading and investing at TFNN.com, also Clearwater, Florida. Gorgeous day, a little warm, but it's going to be nice. Today we've got a special edition of the Power Trading Hour, and what we're going to be talking about is how computer trading has changed markets. We hear a lot about high-frequency trading and algorithmic trading. We're going to dig in just a little bit deeper on that. In the second half of the hour, we've got Scott Patterson. He is a author of a couple of books, one called The Quants, a second one called Dark Pools. We're going to spend most of the time on dark pools, but both books very interesting. It's basically about a lot of high-frequency trading, algorithmic trading, and how it affects us as traders and individuals in the United States, the stability of the market. The subtitle of his book is High-Speed Traders, IA Bandits, and the Threat to the Global Financial System. So we've got a lot to eat here today. We're going to do a little prep work before he comes on the show. We're going to talk about how and what's going on in computerized trading in basically mostly the New York Stock Exchange and some about the NASDAQ. Let's see if we've got something else here to go. There are some pictures there. If you are hopefully watching on Tiger TV, see copies of both his books. You can just go to Amazon.com and check out Dark Pools or The Quants and see Scott Patterson's books. If you are wanting to look in the meantime, just before the interview starts. Now, one of the things is, and I'm going to ask him if this has been updated, but currently, if you believe what Nanex, a firm that specializes in dumping the data for every quote, not execution, but every quote in the marketplace, 70% of all trades are automatic these days, and about 99% of all quotes that could be orders are actually in the queue less than the time that it takes to actually execute them. Anyway, automatic trades fall into two categories. One is high-frequency trades. The secondary one is algorithmic trades. Mostly, this has been a bigger issue since something happened, and that is the government in its infinite wisdom decided to change things. In 2005, they started taking comments for something that would be later come to be known as Regulation National Market System, or Reg NMS. If you're on Wall Street, like everybody, they love to use acronyms almost as much as NASA. Maybe not quite as much. NASA is just a little bit more into acronyms. Anyway, in February of 2000, Reg NMS went live. It requires traders to transact on a trading venue at the lowest price rather than on the venue offering the quickest execution or the most reliability. Now, preceding this, a lot of people went to jail because they were fixing prices, especially in the late 90s into the first couple of years, 2002. Some of the problem, and we'll have to make sure that we get sound into the den here. Anyway, there we go. We did do what I'm going to say. They went from pricing in 2002 to decimal pricing, but up to that point, everything was an eighth of a dollar up or down. So what a lot of broker-dealers were doing were forcing a spread not of an eighth, but of a quarter. And a lot of dealers went to jail on the deal. Daytech and some of the other broker-dealers out there actually got on systems that would allow them to go to actual penny pricing. If you haven't been around that long, everything used to be in an eighth, and actually you had to almost pay in a quarter because of the broker-dealers basically trying to rip everybody off. We talked about the two kinds of trades. The first one is algorithmic trades. These trades are hedges, arbitrages, risk control, and they're put on purposely to be executed. They're not put in to just gum up the system. Option spreads, conditional executions, all these are designed to be in there to reduce risk, and really probably not a big problem with these kind of orders being in the system. A lot of these algorithmic trades may be anything from looking at the price of gold from Europe to America and deciding that there's 50 cents difference. We'll sell it in one place and buy it back in another and capture the 50 cents. Same thing in oil, especially in commodities. Not an unusual trade, and certainly a useful trade for the marketplace to make sure that the playing fields are level, not only in the United States but across the world, especially in commodities. Option spreads came along. For years, options were basically the redheaded stepchild of Wall Street. They pretty much pushed option traders out the front door of the New York Stock Exchange. They were almost standing on the curb, so to speak. Once Black-Scholes, an algorithm, came out, they finally found a way to actually price options. Now options are one of the biggest business in the stock exchanges these days, but they are useful. Most people believe that they do have a use. They are priced, and they make sense. High-frequency trades are a little bit different. These trades are entered in either never to be executed or that they will last only hundredths of a second. That is, that they're stepping in just like the broker-dealers when everything was an eighth of a dollar and actually trying to get in there and making sure that they could at least snag maybe an eighth and sometimes a quarter, depending on how the actual orders were routed. Now, some of the things that are different these days is some of these high-frequency trades are orders only to create liquidity. They are actually buying and selling at the exact same price. So they're making false volume, let me put it that way, but they're also creating a market that looks like something's going on. Much like auctioneers trying to keep a little chum in the water to keep interest in a market that looks like maybe it might be just drying up and keeping people out and the spreads going wider. So not all of these high-frequency trades are bad. One of the things that is most interesting is that if you add liquidity to the New York Stock Exchange system, you actually get up to 30 cents per 100 shares. If you take liquidity out, they charge you 20 cents per 100 shares. So there's actually an arbitrage of whether or not you can add or subtract liquidity, and they all day long continue to do this. And one of the reasons we've seen volumes in the New York Stock Exchange go logarithmically up since that February 2000 inception date for Reg NMS. It is against the law to enter an order you don't intend to execute. Unfortunately, since that law has been in pretty much in effect since the mid-'80s, there's no record of a single person ever being charged for this by the SEC or the Justice Department. Why is this most important? It is that high-frequency traders have decided to gum up the system with phony quotes that will never be executed. There is a thing called a CQS, and this is the Consolidated Quote System. Think about this as the exchange like NASDAQ and every ECN that is allowed to trade on them also. So what happens here? Since 2007, the capacity of the Consolidated Quote System has gone up an order of magnitude over 10 upgrades. a absolutely monstrous amount of quote systems. There are about 10 different times they've upgraded this system, and within 2 weeks, they were again back at 100% capacity of the quote system. The idea of a lot of these orders is just to physically gum up the system so much that there's that literally the computers slow down and give an edge to those folks that have co-located computers. We're going to get into that just in a second. So what is the purpose? It is basically to dump all these quotes, make sure that that an order will never leave the queue before they can pull it off. So they'll put, let's say, an order to buy above $1 above the market or maybe below the market or something, knowing that the orders will never ever get hit, and they actually pull the order back out as soon as they put it in. It never even had a chance, even if it had a chance to execute. They keep the market computers at the New York Stock Exchange or the NASDAQ completely bogged down with this, and by doing it, they create a latency. There's a gentleman named Steve Hammer. He's got a product called HFT Alerts. He calls it financial spam. He's actually written a system to look for this so you can tell whether or not it is an HFT program trying to cause this problem, or whether it's actually some kind of big guy like Goldman Sachs or Merrill trying to actually buy and sell a program, or actually a buy-sell program for a particular stock. Air Force planes dropped massive amounts of ripped foil during World War II and even after it. And this reflected the radar signals back and disguised them from enemy radar. Steve Hammer calls it financial spam, and it's exactly that. It's designed to overload a system and keep other people from getting quotes as quickly as we do out here in the hinterlands. This is a business making huge amounts of money. One thing we did find out is that programmers, and especially one programmer that was arrested for supposedly trying to give away Goldman's high-frequency secrets, was hired on at $400,000 a year. And basically, there are a lot of ads right now that the latest I've seen are still starting at $400,000 a year if you're a programmer that understands the plumbing of the stock market and how to make high-frequency programs that look for opportunities in the marketplace. These programmers are some of the highest paid, in fact, other than the principals in a lot of these trading organizations, are the highest paid people in, let's say, like Goldman Sachs and Merrill. This gentleman was a Russian. He came in 1990. Actually was leaving and was going to be offered by a Chicago firm $1.2 million a year for his programming services. So we can actually look at this. We're going to try to finish this up in the next segment. At the bottom of the hour, Scott Patterson.
It's that time of year again, and the Great Panther Silver Summer Silver Giveaway is back. Every day in June, Monday through Friday, we'll be giving away a Great Panther Silver 1-ounce silver bar, and all you have to do to enter is visit the front page of TFNN.com and fill out your entry. Great Panther Silver and TFNN wishing you a great start to the summer. Sign up today to have a chance to win a 1-ounce silver bar during the Great Panther Silver Summer Silver Giveaway the whole month of June at TFNN.com. With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you gain access to each host charts and computer screen as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, Kate Stalter, Dave White, Larry Pezzavento, or Victor Jones, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV yet, then visit TFNN.com today to see what you're missing. You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC.
Stock market corrections are the number one reason that a buy and hold investment strategy produces the poorest results, and I have 73 years of data that proves it. Now, the good thing about economic difficult times is that the worst economy can produce the best rewards in the shortest period of time. In fact, during the last 130 years, 61% of that time period has been spent in recession. And if you're one of the 70% of American households relying on their 401ks and IRAs for retirement, you need the single strategy that is bulletproof against the turmoil of our stock markets. Go to the homepage at TFNN.com. Under Breaking News, click on Success is a Numbers Game to receive this must-have free report. This bulletproof strategy may be days away from giving the next signal. Don't neglect your retirement, and don't neglect this signal. If you're even a little bit interested in accumulating wealth, providing a better life for you and your family, then go to TFNN.com to order your free copy of Success is a Numbers Game today. Implement the disciplines contained in this report, and success will be yours for the taking.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider of the next big thing today.
This segment is brought to you by Goldfields. For more information, just click the Goldfields banner on the front page of TFNN.com.
As we came back, we were talking a little bit about programmers and actually them becoming the royalty of the street. In reading both quants and dark pools, what you really find out is that these people are, for a better word, hackers who really, just like the hackers of the 80s that loved, and 70s and 80s that loved hacking telephone systems and then later computer systems, they found ways around things, ways to make them faster, algorithms to actually just make huge amounts of money. Programmers making $1.2 million a year is not uncommon if you're the smartest guy in the world also programming. Kind of interesting. I think it's pronounced Linkov. Was actually arrested for trying to. I think he actually sent the code from Goldman Sachs to a server to bypass some of the security concerns. Normally, since it's not an actual thing, software it has been decided by a judge to actually be more of a civil matter. Goldman Sachs actually got the Justice Department coming after him like he was selling the nuclear secrets. He spent about a year in jail before they kicked him back out. I don't know what's going to happen on that, but he did leave a job where he was making about $600 to make about 1.2 to 1.5 million a year in Chicago for another broker dealer to put together their high frequency trading business. I've seen several ads where programmers have quit because they're actually making their entire salary, whatever it is, $400,000 in a day using systems these guys have put together. And the next day they're out putting ads in New York newspapers to say, "Hey, come finance me. We'll make a lot of money." So high frequency trading has really moved along. One of the problems has been the speed of light. That is, if you are a computer system or a trader and you're on the West Coast, you're about 70 milliseconds behind everything going on the East Coast. Just no way for you to actually compete at a high-speed level. Even if you had a computer that was close to the New York Stock Exchange, they were actually renting out the second floor of the New York Stock Exchange, and it was crammed with computers. People were paying hundreds of thousands of dollars to be 1 or 2 or even 3 feet closer to the actual computer systems where the data and the quotes came out. This became such a huge problem that in 2010, they actually went and opened up a new facility. It is 900 feet long if you're looking at the picture on Tiger TV. That hallway, maybe even hard to even tell, runs 900 feet long. It is 400,000 square feet, and it's in New Jersey. So the New York Stock Exchange isn't even really back in New York anymore. It's actually in New Jersey. Everything that pretty much happens on the floor is routed out to this system. The whole idea was that they were going to put traps on every computer on the trading floor of this new facility and make sure that everyone was delayed and actually had exactly the same amount of time and were getting the quotes from the New York Stock Exchange exactly at the same time. This is what the facility looks like from Google Earth to give you an idea. And there are very few people in here. This is a facility that does nothing but cool hundreds and hundreds and thousands of computers all hooked to the New York Stock Exchange. Almost all of them, because of the rent at this location, would have to be high-frequency trading systems. That is a 900-foot-long building, folks, filled with nothing but computers whirling away as fast as they can on the most expensive real estate on the planet. We're going to be back here in just a minute. We're going to have Scott Patterson, and we'll start the interview when we break back. He is a New York Wall Street Journal contributor. He's also been on The Daily Show, if you're watching Tiger TV, and also some of the other places he's been. Rolling Stone. He's been in conferences from the government about high-frequency trading. And, of course, he's written several books. And when we get back, we'll get into a little bit of the quants and then follow up with dark pools and find out what he has to say about them.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the Rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to TFNN.com today. Don't miss out on this great offer. Act now. If you're an investor looking for a great weekly investment newsletter, then now is the perfect time to try out Ken Shreve's Ultimate Growth Stocks. Every Tuesday, Ken breaks down multiple sectors in his weekly newsletter, Ultimate Growth Stocks, with a full in-depth report including specific trading recommendations within his model portfolio, charts, sector analysis, upcoming economic data, along with intra-week trading updates on newsletter positions whenever the market dictates. Right now, you can receive a full month, that's 30 days, to evaluate Ken's newsletter free of charge to see if it fits your trading plan. At less than $75 per month, Ken provides you with his expert trading advice that can pay for itself in no time. Take advantage of this great offer by signing up for a 30-day free trial to Ken Shreve's Ultimate Growth Stocks today. Don't let this offer pass you by. Visit the front page of TFNN.com and sign up now. Kate Stalter's exciting newsletter, Low Priced Leaders, has just launched, and now is a great time to get a 2-week free trial. Every Wednesday afternoon, Kate sends out her weekly newsletter to her subscribers where she focuses on small cap stocks with market caps under $2 billion, as well as low-priced equities with share prices ranging from $5 to $12. Kate tracks a variety of stocks with a combination of strong technical support and solid fundamentals. Many of the stocks featured will be recent IPOs. These newer issues are often some of the biggest price gainers in the market and provide an excellent opportunity for substantial gains if timed correctly. You can catch Kate Stalter live on Tiger TV with her Small Cap Roundup every Tuesday and Thursday at 11 a.m. Eastern Time, and visit TFNN.com right now to get your 2-week free trial to her brand new newsletter, Low Priced Leaders, while locking in the low introductory monthly rate of only $37.50 per month, almost a 50% discount. Act now.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
This segment is brought to you by Direction Shares. To learn more about technical tools for the sophisticated active investor, hit the Direction Shares banner on the front page of TFNN.com.
As we come back, I'd like to welcome to the show Scott Patterson. How are you doing today?
I'm doing great. How are you doing?
Fantastic. We've been doing a little pre-work here before you showed up, talking about some of the systems that actually run the markets here in the United States. You've got 2 books. One is called The Quants, and the second one is Dark Pools. The last chapter of The Quants is entitled Dark Pools. I guess that led into this book, right?
Yeah, that was kind of a foreshadowing of the next book. Although at the time I wasn't planning to do it, but it seemed like a good title.
I guess probably the biggest thing that we need to know now is that 70% or more, maybe you can tell me there's a newer number, 70% or more of all trades on the stock exchanges are actually computer-generated trades, right?
Right. Well, that number is referring to high-frequency trading specifically. So the estimate is 2/3 to 70% of all the volume is high-frequency trading. But there's a lot of other trading that is computer-generated. So I would say probably, maybe more than 90% or 95% of all trading is actually computer-generated today.
So if you'd say algorithmic trading and high-frequency trading.
Right.
So when you look at high-frequency trading, how do you differentiate it between algorithmic trading?
Right. Well, so a mutual fund manager is probably using algorithmic trading to manage his orders. he's sending his buy and sell orders to a trade execution professional. It may be outsourced to a firm like Goldman Sachs or Jefferies, and they're going to handle that order for him or her using algorithms. That's almost how all funds trade these days. High-frequency trading is the posting of bids and offers into the market at a high rate of speed in order to make, a penny or two off of each share that they trade, or even less sometimes. So the goals are different. The high-frequency firms aren't trading in order to invest and hold a stock for any period of time. They're just holding the stocks for a few seconds and then flipping out of them. And they never hold stocks overnight.
Now, we've got even several types of high-frequency trading. Some of it is just what has been called quote stuffing. Mm-hmm. And some of it is actually just created because the exchanges pay for liquidity.
Right, yeah. The exchanges have an arrangement where they will provide a rebate to firms that post a lot of orders into the matching engine of the exchange. So a lot of high-frequency trading these days is now basically designed just to get that rebate. They call it rebate trading. And I think that that's created a lot of perverse incentives for these firms to put out orders in ways, in very, sometimes not healthy ways for the market in order to get those rebates. And the trading is just designed for that. And the exchanges are working with the high-frequency firms, hoping that they'll send them their orders. So the exchanges are competing against one another, and I think it's created this sort of toxic environment where exchanges are, basically doing everything they can to help out these firms, to help them make money. One guy who had worked for one of the exchanges told me when I was working on this book, Dark Pools, that they designed a system that provided guaranteed economics to the high-frequency firms. And, I think that's, you're getting very close to a system that is essentially rigged, if that's actually what's going on.
I mean, I guess the question, there's two parts of the coin here. One is, are they rigged against other players like us? Us normal people trying to play the market, and even if it's a tiny amount, they are no difference than the SOS bandits of the 90s and the people pushing quarter type spreads when you could have done them on an eighth back in '99, and those guys all went to jail too. But
right.
It is almost a wet my beak kind of thing, right? It's just, I just want a little taste, but if I can get a penny a day and double it, by 30 days I'll have $1 million kind of thing, right?
Right, yeah. It's designed to trade a huge amount of volume. These firms will, put in 50 million to 100 million orders a day into the market, some even more. So, yeah, I mean, the SOS bandits, so you're referring to, I show in my book that actually, that in a large way, that's where the high-frequency trading world came from. These guys were using computers to beat the NASDAQ market makers, and out of that evolved these computer systems that are automated. So it really is that scalping kind of trading that the SOS bandits were doing, where they're just jumping in and out, they're making the spread, and now with the rebate thrown on top of it, they get a little bit extra there too. And you got to remember, the other side of the rebate is the guy who pays, and that's usually the mutual funds who they're trying to play the same game these days, but they're not very good at it.
It seems to me, and I don't know, maybe you can tell me that a lot of the business now comes really late in the day for these funds, and I'm wondering if they don't, can't they just trade with each other without going through the normal rigmarole where they're easy pickings for these high-frequency traders?
Well, I think they'd like to, but they're having a lot of trouble getting the liquidity that they need. It's a very complicated system. So we used to have market makers, like NASDAQ market makers or specialists on the floor of the New York Stock Exchange. Those guys have basically been phased out. Now the new market makers are the high-frequency firms. So there are some efforts now to create exchanges where the mutual funds can actually trade one-on-one, but it's very complicated because, sometimes you get in a situation where, all the funds are moving in one direction and you don't have anybody there to take the other side. So there is a role in the market for market makers. The problem is that the system has evolved in a way that is benefiting those market makers too much. At least some would argue that it's benefiting them too much. And, I think that's because of the situation that the exchanges find themselves in, where they're competing against one another to get the flow from these firms. They're offering them all these kinds of advantages.
The first problem is the nickel and diming of everybody that isn't reaping these whirlwinds. The second part is the danger, and that's the subtitle of your book, The Threat to the Global Financial System.
Right.
I guess we got a taste of that with the flash crash, and even to a lesser extent, Facebook just the last 30 days or so.
Right.
But what is, can we quantify what the threat is, or is it just one of these outliers that one day is going to come along and blow up?
Yeah, well, there are a lot of very smart people right now who are looking at how the market operates. These are PhD physicist types who say that the market has evolved into this complex system of computers interacting with one another. And in a system like that, you can get extreme chaotic movements, something that human beings usually wouldn't do. People always tell me, well, what about Black Monday in 1987 when the Dow fell 23% in a single day? There were humans on the floors. There are human market makers picking up the phones, but they forget that a big part of what caused Black Monday was computer-driven trading with futures, automated selling with futures contracts interacting with stocks. So even there you had this, quantitative outlier that bled into the real market, and that's something that I wrote about in my book, The Quants. Nowadays, since everything is run by computers, the concern is that you could have an event in one market, like the currency market or the futures market, spill over into other markets and trigger a globally systemic event. And that's what I'm talking about there with the subtitle. And people have actually given a name to this thing. They call it the splash crash, where a big event splashes over from one asset class into the next. And it could happen so quickly that even if people realize that it was some kind of glitch in an exchange or a big trading firm somewhere, it'll create its own kind of self-reinforcing chaos and affect everybody's lives and real economies.
I saw your interview on CNBC last week, and it was almost dropping the Baby Ruth in the punch bowl thing when you told them that what they had behind them was nothing more than a set for them, and they kind of looked at their shoes and everything else. How long do you think we'll actually see something like that with people standing around a post?
I don't know. I think that the New York Stock Exchange likes having that TV set there, so people. It's a branding image of the New York Stock Exchange, so they invite CNBC on there, and that studio now is that where they film that thing is huge now. It's not just Maria Bartiromo standing there; it's this huge TV set. It takes up all this space on the floor of the New York Stock Exchange, and I got to tell you, I was just really genuinely surprised. I went there that morning, and trading opened up. And, you could practically hear the crickets creaking. It was, nothing happened. I used to cover the exchanges for the Wall Street Journal. I've been on the floor of the New York Stock Exchange a number of times and seen what happened when trading began. And it was a huge rush. It was, everybody's running around and yelling and, a lot of energy. And, when I was there to be on CNBC, it was just, I was really struck by the change. So that was really just a genuine sort of shock for me. And I'm talking 3 years ago, last time I was there. So it's accelerated a lot, and it's going to keep building. This computer shift to computer trading is not going to stop. And I don't even advocate for that because it's just inevitable.
the most expensive real estate in the world used to be the second floor of the New York Stock Exchange. They've moved that all out to their facility, this 400,000 square foot facility, 900 feet long. My question is, I mean, everybody talks about something bad happening. I mean, what if a plane hit that building? Would that be I mean, it's not as easy as when in 9/11 when they moved a lot of things to the backup facility.
Yeah, right.
There's no backup facility anymore, is there?
Well, they claim that they have a lot of redundancies, and I think maybe they, I'm not totally sure about this, but maybe they do have a backup in another data center. But you're talking about the Mahwah facility, which is now where a great majority of trading of New York Stock Exchange stocks takes place, and it is a secret location.
I've got a picture of it here from Google Earth. It's not that secret.
Oh, really? You got a picture? That's interesting. I heard it was blocked out.
No, it's back on up there. It's actually right across from a school. And I read an article this weekend that it has security that's actually higher than the White House and some of the nuclear facilities, including things moat, and they have the ability to fire first.
Wow.
As a national some kind of deal from the government.
I think it is a designated protected security location under the Department of Homeland Security. So it's not like you used to be able to walk in front of the New York Stock Exchange and look at it and think about all the action going on and take a picture. I mean, you can't even take a picture of this thing apparently.
I did find a picture on Google Earth. Maybe someone had kept it. But apparently since this picture, they've added a moat. Which is
interesting. Well, I was actually out there when they were building it. I wrote an article for the Journal about how trading is shifting to this big data center. I think that was 2009. And I remember the chief technologist who was in charge of this thing said, this is the new floor of the New York Stock Exchange. And that is all I was saying on the CNBC. I just think that most people just don't realize it. It's actually quite amazing how little people know about how dramatic this transformation of trading has happened, how quickly it's happened. And that's what I'm trying to do with this book, is to explain to people what's happened, where it came from, give them some names and some colorful stories behind it, so that they know, because I think it's beneficial for people to know how our markets work. If they think that it's a bunch of guys on the floor of the New York Stock Exchange, they have no idea. That's an illusion.
This is a business that's wrapped in huge amounts of secrecy. How easy was it for you to get people to talk about what went on? I mean, this book isn't a how-to to build your own high-frequency trading system.
No, it's not, and that would be a pretty boring book, I think.
Yeah.
That's a technological book that I think you can get books like that actually, but no, it's very hard. These are extremely secretive operations. They're very paranoid. They don't want people to know what they're doing.
We'll be back in just a short amount of time and wrap up the hour with Scott Patterson, the author of Dark Pools and the Quants.
Has the current market volatility continued to stop you out of trades when temporary market spikes move against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped, and you have the advantage of keeping your trades open even when the market temporarily spikes against you. Nadex's innovation has allowed them to come up with a line of unique short-term binary options that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you gain access to each host charts and computer screen as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, Kate Stalter, Dave White, Larry Pesavento, or Victor Jones, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV yet, then visit TFNN.com today to see what you're missing. Would you like a personal update from Tom O'Brien as to what equities he's trading and what his daily trading plan is before the market opens each morning? Every market day, Tom O'Brien sends out his daily newsletter, Market Insights, to hundreds of subscribers that rely on his daily recommendations when it comes to navigating these highly volatile markets we're dealing with. As recently as May 21st, Market Insights subscribers closed out all 5 open positions for a combined profit of over 68% in one day. Profits ranged from 6.5% to over 24%, and all of these trades had been initiated within the previous 30 days. Now is the perfect time to get a 2-week free trial to Tom O'Brien's explosive trading newsletter, Market Insights, an $85 value. Tom breaks down the market each morning with his market take and provides trade recommendations including precise stops and target profit zones, leaving nothing left to guessing. Log on to TFNN.com today and sign up for your 2-week free trial. Make sure you're a subscriber the next time Market Insights subscribers close out multiple winning trades. Take action and sign up for your free trial today.
Put the power of the Chapman Wave methodology to work for you. No matter what market you trade, what time frame you trade in, or your trading style, the Opening Call, Basil Chapman's daily market newsletter, is bursting with the information and trades you need to become a more successful trader.
I've been using Basil Chapman's Chapman Wave methodology for several years now. His Chapman Wave can be used for any time period for not only equities, but futures, currencies, commodities. I've been also a subscriber of his Opening Call, which I find an invaluable tool to help me analyze the potential of the market each day. He gives you opportunities to go short and long. It includes recommendations on stocks. I strongly recommend people using the Chapman Wave, and I very, very strongly support the use of his Opening Call.
To find out more about Basil Chapman and his Chapman Wave methodology, and to get your 2-week free trial of the Opening Call, a $64 value, visit TFNN.com today.
It's that time of year again, and the Great Panther Silver Summer Silver giveaway is back. Every day in June, Monday through Friday, we'll be giving away a Great Panther Silver 1-ounce silver bar, and all you have to do to enter is visit the front page of TFNN.com and fill out your entry. Great Panther Silver and TFNN wishing you a great start to the summer. Sign up today to have a chance to win a 1-ounce silver bar during the Great Panther Silver Summer Silver giveaway the whole month of June at TFNN.com.
Catch Tom O'Brien, founder and CEO of TFNN, professional trader and educator. Also a special guest on CNBC, analyzing the commodity markets. Tom will bisect and dissect the markets. The Tom O'Brien Show, next on TFNN.
As we come to the close of the show here, we are talking with Scott Patterson, and we're going to finish up about his book about dark pools. One of the questions I have is, I kind of was reading around, and I think it's in Dodd-Frank, limits the ability of the Freedom of Information Act to be used against the SEC and the CTFC. Are you aware of this, and how much is this going to affect what you normally have been doing, which is covering regulatory issues for the markets?
I'm not really familiar with any limitations of FOIA requests from Dodd-Frank. Dodd-Frank is so huge, I guess that's one of the problems with it. It's so big, it has so many parts of it that, things like that could slip under the cracks. So, that's kind of troublesome, though.
Yeah, I heard some complaints about that. We've got probably the biggest quants of all time that famously blew up was long-term capital management. Mm-hmm. Is there anybody that is too big to fail right now, like long-term capital management or somebody else like that has the idea if they just keep pushing their algorithm farther, that it'll eventually start spitting out money?
Mm-hmm. Well, I think that's one of the problems with this new trading is that you don't even need to be that big to have a potentially systemic impact on the market. So, a couple of years ago, they had this thing that was called naked access, which was basically a high-frequency firm could do a deal with a broker-dealer and get their access code to an exchange and plug right into it. So they wouldn't even go through the broker-dealer's pipes themselves. They would just go straight into the exchange, and everybody started getting worried that a high-frequency firm could release what they call a rogue algorithm into an exchange, and it could create sort of a huge destabilizing effect and cause that firm to go out of business, but also potentially hurt other people. The SEC has banned that practice now, but they're still concerned that the risk checks that exist at the broker level aren't sufficient to stop something like that from coming into an exchange. And exchanges have their own risk checks, but these trades are happening so quickly and across so many markets that nobody's really sure if something like that will or will not happen. And as I say in my book, this one firm called Progress Software predicted that this year a firm will lose $1 billion due to a rogue algorithm. We haven't seen that yet, but we still got another good 5 months to go. So,
well, I don't know. Maybe we've already seen it in Facebook. They're saying that at least the NASDAQ said that it was a endless loop that caused the problem on the day of Facebook came out with a change just a few minutes before the stock started trading.
Right. Yeah, and that was a software glitch at the exchange level.
Right.
So it shows you how many different places something like that could happen. And yeah, the cost for Facebook keeps rising. UBS has said something like in the area of $300 million is lost at that firm just from Facebook. So that could be close to the $1 billion loss level.
Well, we've got the quants, which I recommend highly. Dark pools, they both kind of read like spy novels. They're not a how-to, but they take you through what did happen. What's next for you?
Well, I'm at the Wall Street Journal right now. I work out of Washington, D.C., and cover financial regulation. So there's a lot going on. I'm working on some stories that are related to what the regulators are doing in terms of things that are happening. And so I tell people to stay tuned and listen to the Wall Street Journal.
Thank you very much.
Thank you.